A huge thank you to SEC Commissioner Hester Pierce there. Now we're talking private market tokenization. We're getting real with Ami Ben David from Ownera, Robyn Friedman from Nomura, Oi-Yee from ADDX, Scott Lucas from JP Morgan Chase & Co., and Berit from ABN AMRO.
Hi, everyone, and welcome to the panelists. Before we start, I'll just say that Robyn had to drop off. She's not feeling well, so get well, Robyn, and we'll jump right in. So the subject of the panel today is digital securities, tokenized securities, and getting real. We've been talking about this for a few years now, but now we're at the stage where it's getting real, and I'm specifically talking about the institutional market. We have here some great people who are actually at the forefront of doing exactly that in the institutional market. And this is the subject we wanted to cover today. So before we go ahead, let's start with an introduction of the panel members. Berit, do you want to take us away?
Yes, absolutely. Thanks, Ami, for introducing the panel and for inviting me here tonight. My name is Berit. I work with ABN AMRO Bank in the Netherlands. I've actually been working in this space, applying blockchain technology within the financial industry and focusing on digital assets since 2014. Currently, I do that in the capacity as innovation manager, work within group innovation of the bank, kind of working with all of the different business lines, so across all the products and segments that we have on developing and implementing digital asset propositions.
Thank you. Oi-Yee?
Hi, my name is Oi-Yee. I'm the Chief Commercial Officer at ADDX. ADDX is a private markets platform. We're headquartered and regulated in Singapore, and very happy to be here with the panel today talking about, private digital securities in the private market.
Yes, and thank you for joining us from Singapore. It is quite late over there, later than in LA. All right,
Indeed.
Scott, over to you in London.
Thanks, Ami. My name is Scott Lucas. I'm at JP Morgan, and I lead our markets DLT business, so building DLT trading products on sort of regulated private permission networks across the different streams of the markets business, credit, equities, rates, etc.
Yeah, and you covered the commercial side as well as the technology, or mostly on the commercial side?
On the commercial side, yeah. We have a technology team that I work with to turn thoughts into reality.
Great. Okay, so I think to start our discussion, we're talking about getting real. So I'd really love to get from each of you just a snapshot of what you're seeing happening, either things that you can talk about or that already went public, or that you can talk about within your organizations around tokenization, things that are coming, or things that you see in the market that you think will come in the coming quarter or two. So I'm not talking about what's going to be in 2 years, because we've heard that 2 years ago. It is about what is coming now, what are we working on now, what do we have going into production, and I'll do it the other way around. So I'll start with you, Scott. Tell us, JP Morgan, what are you seeing?
Sure. I think, well, obviously a lot of activity, and my main focus is really on in the sort of the existing financial markets and products that sit within what we would trade today. So arm's length from crypto. But even in that space, we have our own product around a repo that we launched a year or so ago that we partner with other market participants with. I think we've invested in a company called HQLAX that does a similar thing with tokenization of securities, and then moves those collateral versus collateral. So I kind of feel like from the where are we on the curve, the idea that you can take an existing asset, tokenize it, and then trade that for value across different jurisdictions and different firms, like that's kind of been one, and now it's about productionizing and scaling that to really sort of meet the needs of the market. And I think that will be a complementary tool to existing market infrastructure. But it's a really helpful first step to get businesses over the idea of, yeah, this technology can actually make a significant change in how we think about some of those products that have not changed for a very, very long time. And the next wave of investment we really see is in natively digital assets. So whether it be issuing securities or derivative products where you you can use the underlying technology and the contractual basis of that, and I guess that remove some of the processes we have in the existing system to drive efficiency and speed. And I know, Amy, that's where you're looking at with some of your work. That's, I think, the next level of investment that we'll see, and the next series of efforts will come to the market. And we've seen a little bit of that with issuances by the European Investment Bank, actually issuing a bond onto the public Ethereum network. Really interesting dynamic between public and private chains and existing products in a native way. So I think there's a lot more investment to come on that side. And clearly we are looking at that along with our peers and competitors to see what the client need is, what the market need is, and how we can bring some of that to bear.
And I think that it took some time because JP Morgan, the scale is different. So the Reaper product, for example, this is quite scalable already, isn't it?
It is, I think, but it's really interesting when you look at the freedom that is available sort of outside regulated markets to innovate and move at speed versus bringing a very long period of case law associated with these products with you, and the legal construct around trying to make the technology work in a way that people can agree. There's a really interesting interface there. So it's very scalable, but you've still got to get over some of those traditional hurdles around legal regulatory boundaries that you've got to work within.
Yes,
but it's certainly that argument has been won. It's now just about implementation.
Got it. Thank you. Oi-Yee, you're live and official with some tokenized products. I'd love to hear what sort of products you have, what sort of product you're launching, what products you're going to be launching next quarter. Tell us the whole.
Thanks, Ami. I think where we were very fortunate, ADDX is a blockchain-based private markets exchange. And we sort of started with a blank sheet of paper, right? Designing what we thought should be sort of the optimal building blocks to have a private market infrastructure. So we actually commercialized last year, just before COVID hit. So it was obviously a very testing time. But since last year to this year, we've actually done quite a number of transactions already. Where we see the predominant use case at the moment are funds and the access and the democratization of private equity funds or VC funds, private market type products to high net worth individuals. So, we would have seen our recent release. We did a deal. We did a Partners Group Global CCAV Fund, which we tokenized on our platform. That was last month. We actually just today announced the launch. Actually, we closed the first round of a crypto fund. And interestingly, that is our expression at the moment of crypto exposure, which is the underlying is actually a fund managed by a group called Trovio in Australia. It's actually a bunch of ex-JP Morgan colleagues of Scott, I suspect. And, that was very well received by our investors. So funds, as I mentioned, it's great. It did very well. It's a, very well-performing fund. But where we're seeing the use cases develop over time, and this will become more institutional, is actually on the bond side, as well as the pre-IPO and the structured product side. On the bond side, we now are starting to see issuers come with us on digitally native bond deals. And we think this will be a space that in the next 12 to 18 months will be very deeply developed. One final thing I would mention before I hand it back to you, Ami, it was that with the banking infrastructure, obviously we started out not developing that banking infrastructure because we were a young startup. But you would have seen UOB, United Overseas Bank, which just announced its results today. The CEO mentioned our strategic alliance because I think the group itself sees a lot of interest and potential development with blockchain. They're working with partners like ourselves to see how we can then work with a new setup and a traditional infrastructure to see how that might work.
Amazing. So I think getting real is, we already covered that. And Berit, you have a lot of things happening at ABN AMRO as well. Tell us what you can talk about.
Yeah, absolutely. I mean, that's always an interesting balance to try to strike, of course. And I think for us, when it comes really to tokenizing securities, we don't have anything live yet. We are close to it, though. I think in the past few years, ABN AMRO has spent a lot of time actually more in the area of digitizing trade finance, for example. The focus of the bank has been changed a little bit. So also for the team that's working on digital assets, we're really focused on digitizing securities at this point in time. And the thing that you don't see, and I think that's valid for a lot of financial players, is that we've been working on a lot of propositions and concepts for the past 2 years, and a lot of the time actually goes into detailing out the legal and regulatory frameworks, right? I think that's the thing that really costs the most time and energy, and it's actually really complex, because regardless of which market we go onto as a regulated institution, we have to comply with regulation no matter what, right? So that's a very important thing. What I can say is that we have a couple of issuances and deals in the pipeline. We might even participate in a deal before the end of the year, but definitely first half of next year. And I think next year we'll see a lot more issuances of financial institutions happening. Very interesting, Oi-Yee, that you mentioned to expect that the bond market, the tokenized bonds will take off, because this is really one of our, I'd say, key areas that we're focusing on. It's a business that is, I say, close to us, and that's also really where we're starting, right? We're starting with the segments and with the asset classes that we know really well, that are close to us, that we have relevant networks and let's say a significant reach, before doing more exotic asset classes, which obviously are on the radar. But we do notice that with our partners, peers, investors, that taking the step of tokenizing something already makes it exotic enough. So keeping the rest as much as possible familiar for everyone.
Yeah, I think what's interesting for me is that I've been doing these conferences 2 years ago, and we were talking about the future. Right now, we're talking about, okay, legal is difficult and regulatory is difficult, but we've done this for the last 2 years, and now we're looking at actually deploying stuff. And especially, it's a little bit easier for a mid-sized bank than a huge bank to move faster and maybe go after accounts that are, let's say, mid-sized and not just a huge account. So there's a lot of place for the mid-market also to innovate. What I can say is, from our side, at Ownera, we've been working on the FIN P2P network to interconnect the banks and enable transactions across the market. So we see a cross-section of what everybody's doing. So we're seeing a lot of projects that are about to launch across, you mentioned bonds before, but also, real estate, funds like you guys are doing, Oi-Yee, and private equity fund, hedge funds, even crypto funds. We're seeing money market funds, we're seeing treasury funds coming in, and we're seeing pre-IPO companies also looking at tokenization. So at least 4 or 5 different verticals that are seeing real projects going into production in the institutional market. So what I'd like to take kind of the next question is to talk about the progression of things, or just get your sense on where things are going. It's almost a question on 2 levels. One level of the question is, crypto versus securities, because the thought process, and a lot of people here in the conference would expect that crypto brought us the digitization, the concepts of blockchain and so on. So you would expect crypto to be deployed first in institution, but I get the sense that a lot of institutions would actually deploy securities digitized long before they will, not long, but before they will launch crypto. Do you think that this is kind of a reasonable assumption, or do you think that crypto will come alongside crypto? I mean, spot trading and things like that. Do you think that is the financial institution market ready for crypto, or will it be starting with securities as kind of I'm kind of seeing right now? Berit, you want to start?
Yeah, actually, just thinking about how to answer that question. I think that there will definitely be institutional crypto. I think there is an interest for it and an appetite for it, although it will not be for everyone. And I think it really highly depends on your activities and your profile, and also the appetite that you have as a financial institution. I can say for ABN AMRO, it's not something that we currently have planned to provide any services on. But that doesn't mean that no one else will do that. So for us, will definitely be securities first. And I can imagine that sounds or feels a little bit counterintuitive, because with crypto, the assets are there, the markets are there, liquidity is there, and these are all things that are very, very important also for digital securities to take off. So it might feel strange to not go for that, but there are a couple of other considerations that you have to take into account as a financial institution before you involve yourself with crypto or offer any crypto services. And an important one there is also still regulation. And the regulation, I think, around crypto is different around the world. Even within Europe, wildly different stances from the central banks on what you can and cannot do with crypto and what you should and shouldn't offer. And that just makes it a lot more difficult to navigate also, I think, the crypto industry for Europe-based financial institution. Because even if you would be allowed to provide certain services, you would be kind of confined to your own small market, because 200 kilometers away, the regulation might be completely different.
Yeah, I think I agree with you. And Scott, from what you're seeing at at your organization, other organizations that you work with, I think it's not only that securities are coming ahead of crypto, but actually we're now deploying the infrastructure and the technology, and a lot of these wallets and the technologies might be able to trade crypto later. It's the same technology or very similar technology. It's just that what do you start with, and it's a lot easier to start with securities. Are you seeing the same? Do you think the same applies to you guys?
Yeah, certainly securities, and I would sort of broaden that out to existing regulated financial products are sort of where we need to focus first. And the reason we have to focus there first is because we're allowed to do that, and we're not allowed to get involved directly in the crypto markets. And I think there's quite a lot of coverage around interest from institutional investors and sort of how that might eventually play into the institutional market. But for right now, until there is both regulatory clarity on what is available to you on, and also the cost of doing that, because clearly when you get into that framework, you then start thinking about capital, et cetera, and that has a different expense for an institution like ours than does perhaps for someone else outside the regulatory space or regulated space. That then sort of plays into how that would deploy. So for right now, like, crypto is not in the playbook for us. It's not something we can focus on, but quite clearly there's real benefits in the technology that cryptocurrencies run on. And observing those markets and looking at interesting ways of adopting some of those processes to regulated financial markets to drive efficiency, take out cost, offer different products than we can today, because the technology just lets you do different things. That's certainly the focus from our perspective.
Yeah, and I think for what I think that it has implication for people that are watching us, and I know a lot of people are watching us that are coming from organizations that provide services like custody solutions, settlement solutions, and so on. And they were trying to get into financial institutions with their product, which is crypto product. And one of the things I'm saying to them is, well, it's the same product for digital assets, because a wallet is a wallet, and you should be focusing on offering custodian services and other services for digital securities first, and then you'll get to crypto in the end, but not the other way around. That's an interesting. I think it's a turn of the market that's interesting.
It's separating the sort of what the rails are with what's in it or on it.
Exactly.
And if you feel you've got the infrastructure to offer services related to those rails, wallets, connectivity, etc., then that's a play that would be more acceptable in the short term, because we can't and don't intend on in the short run getting involved in the crypto space until there's real clarity.
Yeah. And the other question I want to ask, and maybe I'll offer that to you, Oi-Yee. The question of private blockchain versus public blockchain. Everybody here in the conference is obviously coming from the public blockchain, while the institutional market definitely started with private markets. When we started the group, we had the group to digitize private markets. We had 70 financial institutions talking about interoperability and interconnectivity. This is the project we're deploying now. and everybody said private only. We don't want to touch public blockchain. But now I start to feel winds are slightly changing. And I know you started with private as well. What do you think about that?
Yeah, I think that look, if when we started the business and we thought and we drafted it on that white piece of paper, as I mentioned to you, I think there was no way that we could have come from the approach of getting licensed and getting in and out of the MAS sandbox without being private, right?
Yeah.
That was just not possible. I think private has a lot of advantages where regulators would like to see, because cybersecurity, certain features, how and all those things that come with the private blockchain, I think are still applicable today. But I think what's happening is in Singapore in particular, because of the way that the regulators are looking at crypto and how they're allowing certain institutions to have the what we call the Payment Services Act licenses to operate a crypto exchange, is that I think we will start to see regulators look at how the public and the private chain could potentially coexist in the ecosystem. But I do think that does force the public chains to then adopt certain measures to ensure that they also meet regulatory standards, or that the private chain has to build certain features in to ensure that the connectivity into the public chain will eventually have the right oversight and the right sort of KYC, AML, all the things that regulators are extremely cautious about. Yeah.
That's exactly the point that, when I talk about public versus private, when we're talking about securities, the public is not really public, because it is, I call it like a VPN on top of public. It's a closed network. It's because you can only allow specific people in based on their credentials, KYC, AML, accreditation, whatever it is. So you have closed networks on top of public networks, and you have so many public networks and so many private networks that, without a network that interconnects all of them, you're going to have just as a mess of networks. So it becomes less important or almost technical to decide to go with a private blockchain or a public blockchain, as long as you can kind of create a fence around the set of clients that you want to work with that meet your institutional guidelines. But I know, Berit, you've been in the blockchain and environment in the Netherlands for a while, so you're kind of a fan of the public blockchains, right? As well. I mean, on a personal level, but within the organization, it's private yet, right?
For us, no, actually not. I mean, obviously, starting out with private blockchains, and I think a couple of years ago that was the norm. Like you said, 70 institutions, and everyone said private only. But at the moment, we don't have any, let's say, projects live that are using private chains. So we're actually putting the ambition for ourselves to, for any new issuances and new projects that we're going to do, we would be using public blockchains. The idea is that, and I mean, I think when you're talking about solutions that can be used also for digital securities, and I think a couple of the important things and important reasons why you want to digitize or tokenize securities or any financial assets is also because increased accessibility, but also the discoverability, and especially the interoperability. I think that's very, very important if you want to ensure that assets can be traded, hopefully at some point in time also across borders, if the regulatory frameworks are in our favor. And I personally think that public blockchains are, let's say, more suited to help us achieve those things. Nevertheless, I do believe that you need probably a layer or a VPN, if you will, of permissioning on top. There are just certain rules that we have to comply with. There are certain things, certain information that you might have to keep or might also want to keep private. So you will have to layer, obviously, the ultimate solution to a certain extent. But I think that underlying infrastructure where those tokens are originated and where they can be traded, I would definitely say public.
Interesting. And Scott, I don't see repo running on public blockchain anytime soon. Am I wrong on this?
No, absolutely not that product. I think, but public and private will absolutely coexist, and I think the financial markets will, and they do, So I go back to the European Investment Bank. That bond is on the public Ethereum chain. There's a sort of a ring-fenced area sort of under SocGen Forge that has sort of where that is held. So this sort of enclaves I think you've spoken about on public chains, they already exist for public securities, and you know there will be other opportunities for that, and I think there will be coexistence of regulated market activity on both public and private chains. I do think that the start point for a lot of this does need to be a private chain, depending on sort of where you are on the curve, in order to get that regulatory approval, in order to keep clients comfortable with the safekeeping of assets and the access to those assets, particularly at scale. So I think there's a bunch of arguments for and against for both of them, but I would expect at some point in the foreseeable future there will be coexistence of assets on both of those chains, and we will need the appropriate cyber and KYC and AML sort of protections that you have on private chains associated with parts of public chains, and that's a technical and quasi-legal problem to solve. That's not a law of physics, so it's solvable. We don't have to break that.
So it sounds we're all open to all these options effectively, and matching the right solution to the right problem effectively. And I think that takes me to the next question, which is, one of the areas where public blockchains are potentially stronger, and maybe not in all cases, would be the settlement side of the equation. Because when you're talking about trading private securities, somebody has to move the private securities, somebody on the other side has to pay, right? Or if we're doing DeFi or something, somebody has to collateralize the security, but on the other side, you want to move money as a lending, or if you're doing lending solutions and so on. Scott, what do you think? How do you see the future kind of the payment leg? Because the whole thing doesn't work if you can move securities digitally, but then you wire the money, right, and wait 3 days. That's not what we have in mind.
There's practical and philosophical questions there that are really quite interesting around sort of
run with it.
Not just how we make it work today, but like so how do consumers who want to get exposure to cryptocurrencies actually get exposure to that? How do they turn dollars into Bitcoin? Like how do you then trade it? Like there's a whole, that's not seamless either necessarily. You've still got to move money from point A to point B at some point, transform it, and then once you're in the ecosystem, you've got a bit more frictionless activity, but you've still got to get in the ecosystem, and at some point you might want to get out of the ecosystem. So there's that problem exists, whether it's sort of in the sort of public blockchain crypto space, or whether it exists in like more regulated financial market products where you're exchanging asset for cash as well, and maybe you do that at a high frequency, or you do that in a different way. I think the interesting challenge inside the sort of more regulated markets, whether it be public securities or private market activity, is what's the expectation and the capability today, and how do we make sure we don't go backwards? And one of the challenges there is securities versus cash, and the existing architecture settles delivery versus payment in most instances. So we don't have I didn't send you the money, or you didn't send me the securities. You get that instantaneous sort of exchange, and removes the credit risk from that particular trade. There's not a lot of cash on distributed ledger out there, so therefore you can tokenize as many things as you want, and you could theoretically tokenize anything. And I think again that's a relatively sort of accepted argument, whether it be a piece of a wind farm, a piece of art, US Treasury, or whatever. You can represent that as a token in whatever form, but unless you have the cash to exchange that for in a way that is equivalent from a versus payment like simultaneous way that you can today, which you can in places, then you go backwards, and actually you're introducing a different type of risk into the ecosystem that actually we've kind of moved away from. So I think to your point around sort of the cash problem and how you manage that settlement leg and what that looks like, if we're maintaining the existing risk profile and moving forward, and you're generating efficiency on the back of that, great. If you're going backwards, I think there's a real challenge there to get people to accept that extra layer of risk as an offset for the efficiencies. The efficiencies and the costs and the time, etc., would have to be significant to then turn around and say, even if it's a 20-minute gap, that has actual practical risk framework implications for financial institutions. There's a cost associated with it. So that I think is going to be solved. And as we see, whether it be the appropriate regulation, and I don't know what appropriate means, but appropriate regulation around stable coins to then have them accepted as part of the broader ecosystem, whether it be central banks issuing a currency or even just moving part of the currency on chain onto a ledger, so you've got regular dollars moving on a different technology platform. But I think bringing some cash at scale will really accelerate the opportunity to improve the settlement, which then takes that risk question away, which means then you're just realizing the efficiency benefits that are available through tokenization. And that piece there, I expect, is something that's probably solvable over a 12 to 24 month horizon, or at least sort of getting into the space where you're bringing mass to that. But it's challenging. I think it's surprising how both on the public crypto side and the digitalized security side, the thing that everyone thinks is easiest, which is cash, is actually one of the harder problems to solve when it comes to entering and exiting either of those markets.
Yes, I think that at least in the security side, you're right. That we are waiting for those kind of long-term solutions, but because we all want to go to production and we're talking about getting real, we are finding the solutions that are immediately available now. And those solutions are, for example, you talk about pre-funded accounts, where you talk about pre-funded accounts where you actually mimic traditional escrow and you give people a coupon for their money and you use that. So that's doable, right? Then you have the stable coins, the USDCs of the world, and how much do you trust them? If you're maybe a small player, you're okay with it. If you're a bigger player, maybe it's too much counterparty risk. And then you go up the ladder, you talk about treasury. Can you use treasury tokens as a means of payment? And I think, Oi-Yee, you're in the camp that you had to find a solution. So I'm assuming you're using some sort of pre-funded account model.
Yeah, that's exactly right. I was just going to say, in our sort of setting, when we set it up, clearly, we have, because it's a private blockchain, it's also easier to execute all of that. So we are instantaneously settling, it's DVP, and we are using pre-funding as a mechanism. But I actually think that sort of going forward, because of the connectivity that we see with the traditional institutions, I think we will solve the cash piece hopefully quite soon. Because if everybody puts their head to how do we connect with a chain, how does the bank connect there, and how does the cash move, I think that's level number one. And as you said, Ami, I think the next step will be things like stable coins. How does that work? CBDCs, how's that going to incorporate into our ecosystem? I think that's actually going to happen quite quickly. I would say, as part of your what's the next 2 years, I think this is within the next 2 years. In fact, I think it'll be the next year.
I think it's moving faster in Asia. Moving over to Berit, you've been involved in some CBDCs, I think, trials and processes and so on, and consortium, but still there's no stablecoin in euro, is there?
Let's say
in euro today.
Yeah, nothing substantial enough that you could settle, large security trades with, so to be honest. But then I'm really just talking about, let's say, the Europe zone. I'm a little bit less optimistic for how fast we will have a solution. I think a euro stable coin is not that close. I think financially that's a little bit difficult at the moment in Europe, because you would kind of have to have a negative interest on that stable coin for it to make sense for anyone to offer it, which is obviously something that no one would accept. So unless you can get really creative, I think it would be hard to have a privately or commercially issued euro stablecoin at scale to be used for security settlement digitally. So besides that, I think a CBDC also for the Europe zone, I don't expect it to be there in the next 12 to 24 months. I think most central banks in Europe are still investigating this. They have, concrete investigation plans for it. They will last at least another 2 years, and only then, could an implementation be starting. And then I think the final, hurdle that I do also see when it comes to CBDCs is that I think a lot of the projects from central banks are currently focusing on designing and implementing a retail CBDC, which actually might result in a design, or is actually very likely to result in a design that can absolutely not be used for security settlement. So I'm a little bit less optimistic on when we'll get saved by the central banks because they're going to issue a digital currency. So for the time being, we have to look at other possibilities and mechanisms to do that. Obviously, pre-funding is an option, although I think in the long term, that's also suboptimal, right? We all want still something better than that. But I do think on the short term, that's one of the mechanisms that we'll have to use for the lack of
it is a funny one, the sort of, and I agree with you, the CDBC, if you turn it into a full-fledged central bank digital currency, actually gets quite complex. There's a whole bunch of factors around that debate that are quite interesting. If you just turn around and say, why don't we just put euros on a distributed ledger path? So I've got target 2 for cash settlements, I've got target 2 securities for security settlements, and now I've got target 2 digital for digital settlements. It's just euros on a different form. And I think that'd be quite helpful if there was an approach for simplification, because you could see, you would then down select to a core technology provider. You would then provide a sort of a natural kind of layer that actually you could extend the capabilities of the currency if and when you chose to do that as a central bank. Like if they wanted to go down that route, a lot of the sort of logistical and infrastructure problems would be sorted to then think about, well, actually now on those rails, I can put other types of digital currencies. But if it's just cash on the European Central Bank balance sheet or cash on the Fed's balance sheet, they have different types of sub-accounts now. Have a digital one. It'd be really interesting to move that. That would be something that could move the needle forward. I'm not particularly hopeful, but it would be a nice halfway house to accelerate towards if we could win that argument.
Yeah. Well, we are now, as I said, we have the solutions of the pre-funding. We can look at other solutions that, again, I haven't seen. I keep talking about the option of using treasury tokens as a payment mechanism because they are securities and they are stable and they are movable. So there's some logic to that as well, and also kind of the regulatory side is being looked into. So that could be an interesting solution. But what I would say right now to whoever's watching right now. Here's a huge business opportunity. Find a way to do a European euro stablecoin and be as big as Circle. So that's something we learned from here. I think for our last few minutes, I'd like to do a quick round of just coming back to a question that I'm always, it's important for me to answer when we talk about tokenization. That's the question of why. Okay, so we are working on tokenization project, but why? What are the big things that are worth this move to the tokenization platform? And I think some of them are quite obvious, but I'd love to hear your opinion, specifically on projects that you are in, where you see the big kind of reasons to do tokenization and why it's so critical for organizations to focus on that. Where shall I start? Oi-Yee, do you want to go ahead?
Yeah, sure, absolutely. We started really thinking about solving a problem or solving a need, right? We started with sort of saying we want to democratize private market investing. How do we best do that, right? What are some of the issues? What are some of the pain points? Fractionalization clearly changes the risk profile of a private market product and makes it a bit more suitable for high net worth individuals. How do we do that on a very efficient ledger so that we are managing all of this, the issuance and the post-trade as efficiently as possible? And as it turns out, obviously, blockchain is one of the most, at the moment, the most efficient and the best way possible to execute that. Now, we started off thinking democratization, but as we went into it, we realized that there's so many inefficiencies in the capital markets that are solvable, so that when we just built a platform, a lot of these things came naturally to us. So issuers came to us saying, we want to do a digitally native bond because we see the efficiencies of a smaller company, for example, not wanting to go the traditional 200, 500 million bond route, do a smaller size, shorter tenor, quicker turn. There's less fuss, there's less intermediaries involved. And, I think that's starting to sort of expose actually a large number of inefficiencies in the traditional markets and traditional securities. So it's not even about opening new markets. It's actually just the traditional, the same clients and giving them different avenues for financing, or giving them different ideas for debt funding or things like that, or pre-IPO raising, for example.
Yeah, well, there's a lot of room for optimization. Scott, what about you? What are you seeing in terms of the reasons why you're going to your organization saying DLT, DLT?
Yeah, I think there's a lot of, I mean, like with any business, big or small, there's got to be a commercial driver for it. So where's the outcome that is relatively commercial? Because like making it a bit neater, if it doesn't have any impact on the economics, like no one's really bothered. And I do think in an environment where there's lots of liquidity, not a lot of yield, but still a lot of heavy cost, then attacking the efficiency angle is quite a useful one, because you can take things out of the bottom line, and simple things like removing inefficiency from the operational process, which then has a cost associated with it. The very fact that to the bond point, like they haven't changed in 100 and something years. Like we still pay coupons semi-annually or annually, because people used to have to tear a strip off, post it away somewhere, and then get it processed, and then get their money, and then account for that in an actual physical ledger. And when we dematerialized bonds through the 70s to 90s, that didn't change. So like there's dematerialization 2.0 coming, which you can turn around and say, well, actually a lot of those processes that we get people to do today, we don't need people to do. We don't need to accrue that credit risk. We don't need to maintain sort of a whole bunch of engines. We don't need to figure out like how much coupon I own because I sold it 100 days into the coupon period versus how much you own, and therefore there's like all of that can just go if you think about a specific bond having a different set of characteristics. And there's a lot of cost in that. And if you can get rid of that cost, like someone wears it somewhere, and particularly in the end result is going to be underlying issuers. So you then make capital flows cheaper. That's a good outcome. Yeah. So I think that's kind of like something, step out of the specific details and look at kind of how we get into like large scale general positive outcomes. Then that feels like it's a way of attacking some of these issues about making better use of capital than spending it on the process. Yeah.
And Berit, from your side, what are you seeing? Also, do you have also focus on optimization, or in the innovation kind of group, are you also talking about new use cases?
Yeah, so actually both. So obviously one of the things that we also started out with is all these optimizations and efficiencies that we could achieve. And although that is true, we also had a little bit of a reality check, right? Because if you do just one bond issuance tokenized, the bottom line of your operations is not going to change, right? So unless you actually do the majority of your, for example, your bond issuances, or the majority of your business completely digital and completely tokenized, only then will your actual costs really go down, of course. So and I don't want to diminish the potential efficiencies and optimizations that you could achieve, but we have to be realistic, as in that's not going to pay itself out on day one. But besides that, indeed, working from innovation, we also have to look at indeed new avenues of business that we could generate. And I think I already heard the smaller tickets. So can we make products and processes accessible to customers that are just below our current thresholds because the technology is more efficient? Can you indeed create, for example, secondary markets? Again, liquidity is also not guaranteed on day one, right? So but I don't think we should be scared of that chicken and egg problem, because if nobody starts it, we'll also never get there. And I think that there is enough benefits to gain to basically start this change, even if the big benefits are only coming a little bit further away.
Yeah, I agree. I think my kind of final comment, I think we're about to close in terms of time. I would say that, yes, in terms of optimization, it's a very easy sell, because you can show it, you can demonstrate it, and it's a good show. But also, if you want to get some excitement within the organization, you can talk about new markets where you can take market share and build new businesses, and that at the higher level of the kind of the financial institution could also be interesting. A good example that I always look at is collateralization. I mean, we've seen from the crypto world that collateralization could be as simple as a pair, that a lending and borrowing could be a thing. It doesn't need to go through 15 layers of approval and credit checks and so on. So imagine you can take your real estate holdings, or your my shares in a unicorn that I founded, and instead of having it sit down I could borrow money against it at a click of a button, and nobody checks my credit and nobody does anything because it's completely automated and DeFi. This is a whole new market, and it's exciting. So that's the other side of the equation, trying to balance this. Okay, let's do things that are significantly more optimized than before, but also let's offer these new things that the digitization offers that couldn't have been done without it. I think we are out of time at this stage, but I really want to thank all of you. It was a exciting and very interesting conversation, and I want to thank you again for coming today. Thank you.
Thanks, everyone.
Thank you.
Thank you.
Good day.
Bye-bye.